Mark Matthews, Head of Research Asia with Bank of Julius Baer, joins us live from Singapore now. Mark, good morning and fantastic to have you back on ET Now. Mark, outlining the importance of the US GDP data. Last night, US GDP data was very impressive. What does that mean for risk on watches?
Well, actually, if you strip out the inventories, the GDP was up 2% Q on Q in the third quarter, which was in line with consensus estimates. And it's wrong to strip out the inventories. We should put them in. But I guess what I'm trying to say is that the consumer and investment and exports were, more or less in line. So it was, I think it was a number that's dollar positive, because after the government shutdown, there was a feeling that a big chunk would be taken out of the third quarter, and that didn't happen. But I do want to put in a caveat that most of the surprise, all of the surprise, in fact, was due to inventory restocking.
Mark, hi, morning. The developed market equities have rallied nearly 40% or more this year, while emerging markets like India and China have just shot up, say 5 to 10%. Is there more headroom in our markets to see a run-up more than what we're currently sitting at up until tapering happens? And B, if tapering does happen come next month, do we see the rally in emerging markets fizzle out?
I think that if you back it up and look at what happened from 2007 up until the end of last year, there was a very large rotation out of European and U.S. stocks into emerging markets because of the crisis in America, which was followed, of course, by a recession. And then we got hit by another crisis in Europe, which was also followed by a recession. But the important point is that both of those major economies, and they are, after all, the first and second largest economies in the world, are coming out of their recessions. And so that massive amount of money that moved into emerging markets seeking refuge from the turmoil and recession in the West is therefore vulnerable. I think that the markets here in Asia doesn't necessarily mean they collapse, but you will continue to see, at least in relative terms, underperformance versus the developed markets.
So, Mark, whenever tapering will start, do you think it will be more like a no event? Because everyone is expecting that tapering will eventually happen or eventually start, and some of the world is prepared for it.
Yeah, I mean, the Fed has laid out three conditions for tapering, and the first is improvement in the labor market, but they have not specified what unemployment rate they want to see. They did say up until September, 7% was the golden number, but they took 7% out of their statements and press release on the 18th of September. And I saw earlier this week that two Federal Reserve papers were published, which one was looking for 6% unemployment and the other was looking for 6.5%. So I think it's pretty clear that we need to see unemployment not just at 7, but below that. The second thing they wanted to see was continued improvement in the economy, and clearly we did get that overnight, so that's a positive. And then the last thing they wanted to see was inflation at 2%. And that is still significantly below, we're not, I don't remember what the number is off the top of my head, but personal consumption expenditure is well below 2. And Janet Yellen, who's coming in to replace Ben Bernanke in March, has said in speeches that she doesn't want to just see 2, she wants to see it above 2 for a prolonged period of time. So putting all those things together, of course they can change their mind anytime they want, but based on what they've told us so far, I find it difficult to see tapering before June of next year.
The script of how emerging markets have moved for this calendar year was a function of the dollar index and comments from central bank. What, to your mind, could influence the script of 2014 for emerging markets?
Well, I think it is the tapering. I think the tapering would be the beginning of a reversal of the amazingly accommodative central bank policy that's been in place. Really, it even goes before the global financial crisis. It's 10 years now that we've had essentially very loose monetary policy. And so I think that everybody would immediately make the connection between tapering and the Federal Reserve's what do they call it? Their prime interest rate starting to move up, and that I think would be another tough event for the emerging market space. And as I say, I don't see in the Fed numbers now, in the targets that they've specified, this happening before June. But they can and often do change their mind. They may say tomorrow that they no longer need to see inflation at 2% or unemployment at 6%. So I believe the emerging markets are still vulnerable to this impending reversal in Federal Reserve policy.
Mark, Indian equities fall under your least preferred list. What makes you so bearish in India?
Well, I must confess that I got it wrong because I downgraded, when the Fed did announce tapering. I guess they started talking about it in February, and then when Bernanke actually said in the next few meetings back in May, late May, then we started to see the reaction in the emerging markets. I did it, and now they've changed their mind, of course. So that takes that at least puts it on the back burner for a while. And I didn't realize that Narendra Modi would be chosen as the candidate in the election next year for the BJP. So having said that, I'd be basically admitting that I got it wrong, I guess. The index is at new highs, and although a lot of my friends in India tell me they're very confident that Modi's going to win, I think, they're people who live in the big cities, and if you go outside of the cities, it's much less clear. So I believe, although it would be wonderful for the market if he won, that it's not clear he will. And it's also possible you could get a hung parliament, which is what was the case in 96 to 99. And that was not a good situation. I think there were 3 elections in those years. So that's why I did downgrade India. And unfortunately now it's just run up so much that I want to wait and see how the politics unfold.
So do you think Indian markets at the current juncture, after the recent run-up, are they now attractive, or there is a bit of a speculative froth which is now visible in Indian equities?
Well, there's speculative froth in practically every single market, equity market around the world, including the U.S. I mean, just look at Twitter last night, up 70% from its IPO price. And as the chairman of BlackRock, Larry Fink, said a couple of weeks ago, there are bubble-like aspects to the equity markets. And he said that in his next part of his comment was that he thought, therefore, the Fed should begin tapering immediately. So India's frothy, but it's not alone. And yeah, that's right.
If I look at the price pattern for global equities, globally now defensives are taking a backseat, small cap stocks are making a comeback, cyclicals are looking okay. The Russell index, which is the benchmark for US small cap stocks, that is sitting at an all-time high. So do you think for 2014, more than defensives, investors should focus on cyclical small caps and mid caps?
I do, actually, because, having just said that emerging markets will underperform and there is the potential they could actually go down on Fed tapering. Broadly speaking, for the developed world, I think the backdrop is still one where the economies are coming out of recession and prices have been very depressed in several markets, like Japan and Europe. So, and with the global economy improving, cyclicals, just if you look back historically, generally do perform better. And so, yes, it is a space that we should stick with.
Mark, sectorally, you've always liked IT and financials. When it comes to India, would that call as well stand? Because while IT has really run up in the last leg of the rally, it's the financials which have underperformed.
The financials are, I think they're probably okay here if you can withstand some pain, which we'll have to do because I don't think rates are coming down anytime soon. And rates in India, like in the U.S., are data dependent. So if the inflation comes down, then rates will come down, and that'll be good for the banks. But right now the inflation looks a little bit sticky. So, I think we're not on the cusp of any new credit cycle, but because they have underperformed, they shouldn't really fall a lot more. And with the IT sector, Tata Consultancy up 70% year to date, then I think it's a bit late actually.
Mark, more than anything else, do you think lack of options could be the big reason why equities will do well? Because gold has certainly lost a shine. In a rising interest rate environment, fixed income products, they rarely do well. So if I look at the global assets right now, equities is the only one which offers a little bit of value and some growth.
I agree wholeheartedly with what you said. I think that the fixed income asset class has benefited the most from the crisis and recession of the past few years, and bond prices are at all-time highs, so I don't see capital appreciation. Don't mean to say that we should have no bonds in our portfolios, because they do reduce volatility and provide income, but the capital appreciation in that asset class is over. Now, equities, they don't like rising rates either, but there's a very important number, and the number is 5. So when the Treasury yield is at 5% or rising, there's actually a negative correlation with the S&P index in the United States. But when it's below 5%, even if it's rising, it tends to have a positive correlation, and that's based on regression analysis going back to 1963. So I think that until the 10-year Treasury note yield in the United States gets to 5, that we're in a beneficial environment for equities, because the economy does continue to get better.
Mark, really appreciate you taking the time out and speaking with us.